I want to spend a few minutes talking about the banks and what they appear to be doing with home lending. Now, why is this important? It's important because we need all of us, people, to be able to pay back their home loans. Because if they don't, then the banks wear big losses, especially if housing prices are falling. And then that means that everyone else's loans get more expensive. The banks take a bath, house prices fall, and we get into one of these situations like they saw in the United States in 2008. That's the worst case scenario. Not suggesting that's going to happen here necessarily, but it's why it's important. It's important that people are able to pay back their loans. Now, banks bear a lot of responsibility here. They need to be responsible lenders. They shouldn't be writing home loans to people who don't have the capacity to pay them back. That's why when you go and get a home loan, you need to prove your income, you need to provide your bank statements, you need to provide good evidence about your living expenses and all of that sort of stuff. Now, that's the backdrop to this story that's in the Australian newspaper's business section this morning, which I just want to read the first paragraph to you, and then I'm going to get a guest to explain it to us. The number of home loans, reports Michael Rodden in the Australian, the number of home loans that are approved, despite not meeting serviceability requirements, i.e. there are questions about whether people can actually pay them back. The number of home loans that are approved despite not meeting serviceability requirements has soared to its highest point since before the global financial crisis, prompting warnings from analysts. What is going on? One of those analysts is Martin North. He is the principal at Digital Finance Analytics. Martin, good morning.
Good morning, Gareth.
We've seen a crackdown in recent months, partly something that's been pushed by regulators, but a crackdown on interest-only loans because of exactly this issue, about questions about whether people can pay them back. That's right, isn't it?
Well, there's been heavy pressure from the regulators over the last couple of years to get the banks to tighten their serviceability criteria, and that essentially is two things. The first is making sure that they actually ask the right questions with regard to households' existing commitments. Mm-hmm. So in other words, what's your income, but also what are you spending your money on currently, and that includes other debts, and also what happens if interest rates go up. So effectively there's a minimum sort of floor below which they calculate repayments. Now, those were very, very loose. And in fact, they are still quite loose, but there has been some tightening. And the focus has been on interest-only loans, mm-hmm. but not only interest-only loans. So, the regulators have said interest-only loans are intrinsically more risky. The reason for that is that people are borrowing but not repaying any of the capital. And so after repaying the loan for a good number of years, you've still got the loan to repay because you haven't repaid any of the capital. And of course, if prices go down, that's a problem. You've also got owner-occupiers who are looking at the house prices that across the country, in many places, have been rising significantly mm-hmm. relative to income. And so they try and stretch themselves to be able to get that loan, to be able to buy the property. And of course, if the property continues to rise, then people probably won't, struggle too hard, except incomes are flat, static in real terms, costs of living are rising, and interest rates probably will rise eventually in the next 2 or 3 years. So there's a lot of issues. Now, because the banks have been tightening their own internal standards, partly in response to the regulators, the interesting statistic that came out from APRA was now there are more loans being approved outside those normal standard criteria, and that is a concern because those are the risks that we're trying to avoid. And of course, the banks really want to lend because mortgage lending is the only game in town when it comes to profitability. So you've got this tussle between the banks on one hand trying to be responsible lenders and legally obliged to be responsible lenders, and on the other hand also wanting to write business.
So my sort of fundamental question is, how come any loan is approved if the lender doesn't meet serviceability requirements?
Well, that's an interesting question. There may be some peculiarities. So, for example, people might be expecting a big bonus or something later, something that's a little bit less than 100% certain, but or perhaps it's subject to another property sale that hasn't yet gone through. So those will be some of the examples of things that might move it outside normal serviceability. But I still think that we have a number of loans being written right at the top edge of achievability, shall I put it like that. And what that means is that to get them over the line, then the banks just move the dial a little to sort of get them through. But there are significant risks in doing that. And the problem is the risks don't hit immediately, right? They hit 2 or 3 or 4 years down the road when, in fact, perhaps interest rates have started to rise and maybe property prices have started to slide, and all of the other factors in the economy are not working as you would hope. And that was precisely what happened in the US. So if you go back to 2005, 2006, lending standards were relatively lax.
Yeah.
People were getting big mortgages. They were piling into the property sector. They were seeing home prices go higher and higher and higher. And then all of a sudden, it all started to go terribly wrong. Interest rates started to rise, prices started to slide, people tried to sell, and as they bailed out, prices slipped further. And that's the sort of the worst case scenario that we're obviously trying to avoid.
Yeah.
But serviceability is a fundamentally critical thing, and I don't think we necessarily have it right in Australia at the moment.
And this is sort of the source of my alarm here, Martin, because anyone who's followed that US story of the GFC, and anyone who's perhaps seen the movie The Big Short, which does a pretty good job at explaining and trying to and break down and distill all the forces that were in play that caused that crisis, you had exactly that dynamic of lenders effectively getting greedy, not doing their due diligence on, or just not even caring about whether people could in fact service loans, because the profits were there to write the loans. And to hear you describe a similar phenomenon, I'm not saying it's as widespread here in Australia, but to me, it is quite alarming. It's almost like you are setting the fuse for a potential crisis down the track.
Well, I think that's true. And let me give you some sort of additional colour on here. We survey households all the time, right? And so we know what their incomes are and what their expenditure is and how that relates to their mortgages. Okay. I can tell you that around 22% of households who have mortgages currently from 2 or 3 or 4 years ago would not now get those mortgages if they applied again on the current serviceability standards that exist. So there has already been some tightening, right? So there are people right up to their eyeballs in debt and just about keeping up with, the repayments, but it's really, really tough because incomes aren't rising. So we already have a sleeping problem inside our housing portfolio. Then, of course, you've got the question of, were households completely truthful with
yes.
their declarations, and were intermediaries like mortgage brokers assisting potential borrowers to essentially dress their expenditure the right way to be able to clear the hurdles. And then there's some suspicion that some of that has also gone on as well.
Well, I don't feel any better, Martin, but I feel better informed, so I appreciate your time.
Yeah, I'm sorry I can't make it better, but at least people should be very, very careful and really ask the questions themselves. Don't rely on the bank and using the bank's serviceability standards. Do the math yourself is what I'd say. Yeah,
that is a really good point. And I think especially for people who use mortgage brokers, I think that is also the case. I know that there are some brilliant mortgage brokers who are really good and really have their clients' interests at heart, but I suspect there are also some people for whom they are just happy to write the biggest loan that they possibly can and take the commission and move on to the next one.
Yeah, there's a spectrum. I think most mortgage brokers are doing the right thing, and they have a legal obligation to do the right thing as well.
Yeah.
But at the margins, you suspect there will be a few problems. And, nobody knows. The problem I have is that nobody really knows the degree of risk we have in the system at the moment, because we've been riding with very, very low interest rates and accelerating house prices in most states.
Yeah.
But if it starts going wrong, and it could go wrong relatively quickly and relatively dramatically, that's when it all comes under the roost, and the tide goes out, and you see whether you've been building on the sand or on the rocks.
All right. Well, I've got my fingers crossed, Martin. Thank you.
Good to talk to you.
Martin North, Principal at Digital Finance Analytics.